Hi, and welcome to the third video in the third module of my foundation course for property investors. And this video looks at the decision you have to make between investing for rent, capital gain, or investing for both rent and capital gain. And because this is a financial dynamic video, there is a blueprint that you can download from propertyinvestoronline.com. Now, when you're deciding what to invest for, rent, which is cash in your bank each month, capital gain, which is cash in the bank on sale of the property, or a combination of both, you have a dilemma. Because projected best rents and best gain cannot be achieved in the same property, or the same neighborhood, or really the same location, for reasons that I will show you. In fact, it's like a seesaw. Best rent and yield equals lower gain, so top of the seesaw is the rent, the monthly cash flow. At the bottom of the seesaw is the gain potential. Put gain to the top of the seesaw, and you will have less cash in the bank each month. And these are the reasons why. Generally, low-cost properties in any location generate higher yields. And the reason for that is that if the local rent is £5,000 a year for, let's say, a 3-bedroom terraced house, and that is the market rent, and probably will be close to the local housing allowance or housing benefit rent, and the landlord needs, I say needs, a 10% return to make the investment worthwhile, and out of this 10% he has to pay his mortgage costs, his insurance, repairs and maintenance, and factor in some voids. So he has worked out that he needs to receive a 10% return, but the local market rent is £5,000 a year. He will not pay more than £50,000 for that property. So the cost of the property is governed by the return the landlord needs based on the rent that he can achieve. Now, some landlords will reduce the loan to value, which means they could take the yield down a fraction and pay slightly more for the property. But most landlords work at close to the maximum LTV, or loan to value, that's available, and therefore they, as a group, will pay £50,000 because they need to achieve this 10% yield. A private owner could come along and pay slightly more, but in the main, £5,000 rent, local rent, governs the buy price for the investor. Increase the property value to £100,000, double it, and the required yield remains at 10%, because the same costs exist at £100,000 proportionally as existed at £50,000. The mortgage will have increased, the insurance will increase because it's a more expensive property, the probability is that repairs and maintenance will increase. If you're employing a letting and managing agency, his costs will increase in pound terms. He may still be charging, say, 12% of the rent, but he will be charging 12% of a £10,000 rent if it has a 10% yield. So increasing the value of the property to £100,000 still requires a yield of 10% or a rent of £10,000, double the £5,000 on the £50,000 property. And this rent of £10,000 is simply not achievable. As you increase the value of the property, you don't proportionally increase the value or the rent achievable. Now you might ask, if that is the case, why do people buy £100,000 properties if they can't get the 10% yield that they're looking for? And I'll show you why in the next section. But just to reiterate this point, the rent that is achievable drives the property price, coupled with the yield that is required to make the investment viable. a £5,000 a year rent, and the investor requires a yield of 10% to make the investment viable, results in a property buy price of £50,000. Now let's move on to the capital gain calculation, the other end of the seesaw. High cost properties in any location generate greater cash gain returns. And using the same values as we used in the yield calculations or the yield example, property value £50,000, the gain rate locally is 5%. At the end of the first year, the cash gain will be £2,500. £2,500 is 5% of £50,000. Increase the property value to £100,000, apply the same gain rate, and the resultant gain is doubled to £5,000. 5% of £100,000 is £5,000. Now, for the gain rate to reduce, the cash gain to reduce to £2,500, you have to reduce the gain rate on the £100,000 property to 2.5%. And bear in mind, in any single location, that the higher value properties are scarcer, there's less of them. It is unlikely. And also historically, the difference between £50,000 and £100,000 properties has been maintained. This gap does not reduce. If the £50,000 property is, let's say, a terraced house, and the £100,000 property is a semi-detached house, for example, there is a price difference between terraced houses and semi-detached houses. And whilst they might not necessarily increase at the same gain rate, the gain rates won't be that different. And therefore, high-cost properties generate higher cash gain returns. And the moment you start compounding this, the moment you start year on year, which we will look at later in this foundation course, the moment you bring in the effect of compounding, because you're not going to sell it at the end of the first year, you might sell it at the end of year 5 or year 10, the difference becomes quite enormous, and you'll see the effect of that later in this foundation course. And that is the reason why you have this dilemma that I mentioned at the start of this video. Do you invest for rent, cash in the bank each month, capital gain, cash in the bank when you sell the property, or a combination of both? Go for rent and you can choose a single location. Go for capital gain and you can choose a different single location. Go for both and you've got to operate across 2, maybe more locations. Okay, well that brings me to the end of this video, which I hope you found interesting and enjoyable. And in fact that brings me to the end of Module 3 of 17 modules in the foundation course. Module 4 will be devoted to what is yield, the costs that affect yield, high yield locations where you can invest to generate the best yield, and the advantages and disadvantages of going for yield. There are always advantages and disadvantages to any aspect of buy-to-let or property investment. So that's what we will look at in Module 4. I look forward to seeing you. I thank you for watching and listening to Module 3, by the way, and I look forward to seeing you in Module 4. Thank you.